Joining us now is Joseph Cohen, a Columbia Business School professor and retired Goldman Sachs partner, joining us on set on this Friday. Thank you for being here with us.
Good morning.
We got to talk about the outage. So, of course, we see that affecting Microsoft. You think back to earlier this week, the geopolitical risk really slamming NVIDIA, and then you think about concentration in this market, where it feels like these idiosyncratic risks are becoming index-level risks. And I'm just wondering how fragile that makes markets at this juncture.
I think that is the question of the day. Actually, it's such a newsy day. There are many questions today. But one of my big concerns since early this year has been the concentration in the market. And basically what we have had is, I don't want to call it a mispricing, but we've had such gaps in relative valuation that it's something that is probably not stable. The question has been, what was the catalyst going to be to have a swing from one disequilibrium back down to more of a valuation equilibrium? And I think we're starting to see it. Whether it's the outage today, which hopefully will be short-lived, or more likely it's people recognizing that these stocks and these companies that have been identified as the best 5 or the best 7 are not the only opportunities. There are other securities that are trading at PE ratios, price-to-sale ratios, and so on, that are much more attractive than these are. And then there's the final question we have to ask, and that is, was everyone a little bit too enthusiastic about AI? Obviously, so many companies did invest in terms of their CapEx. Are they getting out of that investment what they had hoped? And maybe the expectations have been premature. They may get there in terms of the ultimate productivity gains from the companies, but maybe we're not there.
Or maybe not, right? I mean, I think we've all bought Jensen Huang's story, hook, line, and sinker, that this technology is as much of a game changer as the internet was, or the steam engine, right? And Jim Covello over at Goldman Sachs raised a really interesting point. He said, most technology transitions in history, particularly the ones that have been transformational, have seen us replace very expensive solutions with very cheap solutions. And this is not a cheap solution, right? I mean, a chipset from Jensen costs like $50,000. So what do you think about that idea from Covello, pushing back a little bit? He's one of the few names I've heard do that.
Of course, I've known Jim since he first came to Goldman Sachs. And so I have very high regard for the kind of work that he does. And he can also call on the work of the other research analysts at Goldman and from the companies themselves, who are basically reporting that they're not quite seeing the returns that they might have liked or expected. So yes, that is a point. There's also the economic history aspect of it, which always intrigues me. And what people often forget is it takes a long time for technologies to become fully incorporated before you really understand what the aggregate impact is going to be on the economy. And I think that people underestimated how long it was going to take for AI to really take full form. So we don't yet know what the full consequences will be, but the early reading is disappointing in a number of industries.
Abby, if you really believe that there are other places in this market to find gains in the longer term, and if you believe in the rotation that we've seen this week, the move into small and mid-cap stocks, the move into value, how strong is that movement? How much room does it have to run?
I do believe in the rotation. My work is always based upon fundamentals and valuation. And I look for where are the better opportunities. And investors are moving into those areas where there are better opportunities. Let's keep in mind not just the concentration in the United States among that small number of beloved stocks. The United States market itself has dramatically outperformed all others. The PE ratios, price-to-sale ratios, and so on in the U.S. equity market much higher than they are in others. And so maybe it's also time for U.S. investors to think again about diversification, not just within the domestic market, but globally as well.
Well, thinking about diversification, especially when it comes to geography, I mean, thinking about the U.S. market, it feels like tech is too big to ignore. And then you think about the global market, it feels like the U.S. is too big to ignore. And there's a lot of great arguments for having a more global lens, but I feel like the question always is, what's the catalyst? What would cause that sort of catch-up trade?
I am a long-term bull on the United States. I'm very enthusiastic about our growth prospects. Our economy has done extraordinarily well the last few years. The labor markets are great. Corporate profitability is great. ROEs are unprecedented. So don't get me wrong about my thoughts here. But I do think that there are some other markets that are not priced for perfection, and that's where the opportunities are. And I always look not just at the valuations based on fundamentals, but rather if you are either overvalued or undervalued, which is the usual case, you're not typically at fair value, what will the catalyst be to get that pendulum swinging again? We have seen the pendulum start to swing in technology in the United States, but I'm always thinking intermediate to longer term, and one of my concerns is this. If we have a change in policy in the United States which is not supporting long-term investment, for example, we've had legislation of 3 important types passed in the United States over the last 2 or 3 years. One is to support public infrastructure, including spreading out the use of broadband and internet in rural communities throughout the United States where it was in very poor shape. Not to mention rebuilding bridges and roads and airports. The second thing that we are investing in now is our own technology through the CHIPS Act, making sure we're building semiconductor fabs in the United States. And the third thing that the legislation has enabled is investment in energy and alternative sources of energy. And one of the things we know, whether it's the AI revolution or the use of cloud computing and so on, is we need a lot of electricity. We have to make sure our grid is up to standards. We also have to make sure that we're taking advantage not just of hydrocarbons, but also of alternative sources of energy. And one of my concerns as a potential catalyst would be, what if the Congress does not continue to fund what I consider to be significant intermediate and long-term priorities?